of Nadex spreads. Some of you guys feel like you have a decent understanding of what is a Nadex spread and how does it work. But I've talked to a lot of people that say, hey, I've watched the webinars and the videos about the basics of spreads, and I get them, and I understand they're supposed to move $1 a tick at expiration, but I get into these spreads and they don't move. Like, they're not working out for me. And I think it's something very important for us to cover. If you guys have been trading over the last few weeks here, you've seen that the markets are moving like crazy, and especially the end of last week and even today, some huge moves in the market, especially in in the Dow and the Nasdaq. And so I want to make sure that you guys are able to apply what you're learning here on these webinars in your day-to-day trading, especially with these great movements of the market. I want to make sure that you're able to take advantage of and choose the right spread as opposed to the wrong spread. So let's jump in here. We're going to do just a quick review of kind of the basics of spreads and how they work. Nothing too long, just real quick to set our foundation. Then I want to hop straight on to the Nadex platform here and try to show you a couple of examples of how different spreads could be used differently, or how choosing one spread over the other might help you understand why something wasn't exactly working out for you. But we're getting close to, we're only about an hour and 15 minutes away here from the expiration of a couple of spreads. So I want to jump into something here in just a second, but let's knock out our disclosures real quick. Trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. The information here in this webinar is for educational and informational purposes only, and is not an offer or a solicitation of an offer to buy or sell any particular financial instrument offered by Nadex. And past performance not indicative of future results. Okay? So before we jump any further, I want to do something real quick just while we have time. I want to pull up a quick chart here. Okay? Here's a chart of TF, which is the Russell. And if you're on Nadex, you'll see it listed on Nadex as the US Small Cap 2000. So let's just say, as an example, okay, I'm not giving any kind of trading advice here or telling you to take this trade. It's totally just as an example. Let's say that you thought the Russell was going up and you wanted to buy. And so you're clicking through these spreads and you're trying to figure out which one you want to take, right? So you pop up a chart, or you pop up a ticket here on just, for example, this top spread here, this 1250 to 1280. And for some reason that's taking a moment to pop up. Let's see here. Oh, all right, I'm going to have to log back in here in a second. There we go. Let's see here. Okay, and you're like, all right, well, I want to buy this. If I buy one, ooh, look at that. Max loss $6, max profit $2.94. I only have to put up $6. All right, so you like that, right? Whatever strategy or system you're using, whatever indicators on your chart you're using, maybe you're saying, all right, the market came down here, looks like we're going to go up, so I want to buy. So I hop on over to Nadex, right, and I'm looking through some spreads, and I'm like, okay, I've only got to put up $6 for this spread. I like that. Now let me go down here to this spread. Okay, what are my options on this spread? If I want to buy this spread, buy one, ooh, I got to put up $38. I think I'm going to go with the $6 spread because I only want to put up that much, right? How many of you have ever done that? Picked your spread completely based on how much money you got to put up to get in the trade. All right, but I want to point out something here, okay, and then we're going to come back to it. On this spread up here, okay, where you only had to put up $6, what price were you able to buy that spread at? 1250.6, right? 1250.6. Let's mark that on the chart here. 1250.6 is right there. Okay? Now, what about that other spread right here that you had to put up $30-something for, right? Is it this one? Let's see here. Let's just say you wanted to buy this spread right here. All right, you got to put up 37 bucks. But what price are you buying into this spread for here? 1223.5. 1223.5. Where is 1223.5? About right there. Okay, everybody see that difference there? Okay, so up here, $6 that we had to put up to get in that trade, right? Down here, I believe it was, what was it, $37 to get into this trade, okay? And where is the market at right now? The market is currently at, let's just take a look. The market is currently right here, okay? So I want everybody to keep that in mind, all right? And we're going to come back to this in just a few minutes and piece it all together, okay? And we're going to see why this example, perfect example right here, might be part of the reason that spreads are not working out for you exactly like you want them to, or exactly like you might be expecting them to, okay? So we just went off track a little bit there, but I wanted to get that, and I wanted to show you live what was going on. So if you're brand new to spreads or you're brand new to Nadex, hop on over to nadex.com and you can get some great information up here on these tabs about who is Nadex, what is Nadex, and what do they offer. Basically, Nadex offers two different products. They offer binary options and spreads. Today we're talking about spreads, but you can go through both of these tabs here, get some great information on both. If you've not traded spreads before or you're not real familiar with them, you can go back through the webinar archives here on the Nadex site or on the Nadex YouTube channel. And just not too long ago, I did a couple of webinars on the basics of Nadex spreads, Nadex spreads 101. I kind of walked through them in detail. I'm going to do a quick review of it here just in like 5 minutes. But if you want to make sure you have a good handle on them, you can go and check out those archives there. Over here under trading platforms, you can go straight to Nadex online at www.nadex.com. They have a great mobile app, but I want to bring your attention right here to Demo Trading Platform. This is an extremely powerful tool that you need to make sure you're taking advantage of, and it's free. Nadex will give you a free $25,000 demo account, all right? And all you got to do is just select a username, put some quick information in, and hit Open Demo. In just a few moments, you'll receive an email with a temporary password, and you can log right into your Nadex demo account, okay? It's a great place to get familiar with Nadex, who they are, get a good feel of the platform, what instruments they offer, how to enter and exit orders, and just a great way to test out some different strategies, okay? So if you don't have one of those, go ahead and hop on right now, even while we're on the webinar, and get your demo account. It might make it a little easier for you to follow along here on a few things. So take advantage of that free tool. My name is John Skelton. I'm not with Nadex. I'm with a company called Apex Investing. Apex and Nadex, two completely different companies. Apex, we're an online company of traders helping traders. We've got over 20,000 members. We're an education-based company. We've got live trade rooms and trading systems and indicators. We focus a lot on risk management and probability as far as our systems and strategies. That's one of the reasons we love the Nadex products, with the upfront known capped risk of Nadex, and the fact that you can get into trades and get into opening a Nadex account even with a really small amount and a small account balance. We're traders just like you. We're a Nadex education partner. We do these webinars each Monday, these Nadex application and strategy webinars. I've been with Apex now as head of operations for about 3 years. I've got a history as a licensed stockbroker and in a banking background. And I'm an educator. I do a lot of training. I'm a trader just like you. I trade Nadex binaries and spreads every day. And so we're just here to kind of help educate you, give you some free education, open your eyes to some different things that you can do with Nadex binaries and spreads, and just kind of show you a little bit about what we do and how you can incorporate it into your own training. So today, Common misconceptions of Nadex spreads, how to pick the right spread, and how to understand premium, pricing, and proximity. Okay, so let's do a quick basic overview of spreads. All right, one of the great things about the Nadex exchange, all of their products are capped risk. You cannot lose more than you put up. Your risk is the initial cost to enter the trade. All right, you can trade stock index futures, commodity futures, and cash Forex. And the price is driven by the underlying market. It moves in pips. Pips is the last digit quoted. And every pip is worth $1. Let's do a quick review here. All right, I like to call spreads boxed spreads because if you draw them on a chart, they look like a box. All right, spreads have a top and they have a bottom, what's known as a ceiling and a floor. Okay, let's just look at an example here. Let's just say this was a euro dollar, and this particular spread had a bottom or a floor of 1.2400. And it had a ceiling of 1.2500. Okay, so the spread is the difference between the floor and the ceiling as far as how wide the spread is. So this particular spread is a 100 pip wide spread. All right, and it moves in pips or ticks, the last digit quoted. All right, each pip is worth $1, and there are 100 pips. Okay, so let's take a quick example of how a spread actually works. Let's say that we were going short. We're selling a spread. We think the market's going down. Okay? Well, we can't lose additional money above the ceiling. So if I think the market's, if I'm selling, I'm saying the market's going down, right? But let's say I'm wrong and the market goes up. Well, I don't lose additional money above the ceiling. The ceiling caps my risk. Okay, and I don't get stopped out, meaning just because the market came up and hit that ceiling, it doesn't close my trade. My trade is still open, which I like because that way maybe the market comes back into my spread, right? So, but if I'm right and the market does go down and I'm selling, all right, I don't make money below the floor of the ceiling. So I only make or lose money within the top and bottom of the spread, or the ceiling and floor of the spread. Okay? So let's just, for example, say that I think the euro dollar is going down and I want to sell it. And I sell right here at 1.2490. Okay, that's the price that I get in. Well, what is my risk? Well, if I'm selling at 24.90, saying the market's going down, if I'm wrong and the market goes up, where is my risk capped at? Because I can only lose money up to the ceiling. So the ceiling is 2,500. I got in at 24.90, so that's 10 pips difference, right? So my risk in this example is only 10 pips. And if the way it works with spreads is $1 a pip, what is my risk on this trade? Just to make sure we're following along here. What's my actual risk in this trade, or the most I can possibly lose here on this trade with one spread? Yeah, $10, exactly. All right, because it's 10 pips to the ceiling, it's $1 a pip, 10 bucks. Okay? So, and what happens if the market shoots up 50 pips against me? I still only risking $10 because I'm protected at that ceiling. Okay? So, each pip is worth $1. There are 10 pips of risk, so my max risk, 10 bucks. Now, there's 90 pips of profit potential, right? Because I'm selling at 24.90 and my spread floor or bottom right here is at 2,400. So from 24.90 down to 2,400 is 90 pips. So there's 90 pips of profit potential. Each pip is worth $1. So the profit potential is 90 bucks. Okay? Let's look at the opposite example. If I'm buying, I think the market's going up. Same thing. If the market is going up, I can't make money, additional money above the ceiling. But if I'm wrong and the market doesn't go up, it goes down, I don't lose additional money below the floor. And I don't get stopped out. Just because the market hits a floor or ceiling, it doesn't close out the trade. The trade is still open. So same type of example. I think the market's going up. I buy right here at 24.10. So I buy right here thinking the market's going up. But what immediately happens? The market pops up and then boom, comes down against me, right? But I bought at 24.10. The floor is 2400. I have 10 pips of risk. $1 a pip, $10 of risk, right? Now remember how I said it doesn't stop you out just because it hits that floor? And you're glad, right? You don't want it to stop. You don't want it to close out. It already went all the way to the floor. You're already down your max risk of 10 bucks. Why close it out? You're glad it stayed open because the market came down. Then what? It comes back up, and what does it do? It goes all the way up, right? So you're glad it doesn't close you out just because it hits a floor or ceiling. All right? So I bought at 24.10. I can make money all the way up to the ceiling of 2,500, which is 90 pips of profit potential, $1 a pip, so profit potential 90 bucks. Now I can close it at any time. If I was able to buy into the market right here at 24.10, when that was the price of the spread, I can sell it when it gets up here to 24.50. Okay? Let's say, all right, I can get out of it, I can exit it early, or I can wait till the spread expires. Okay? And at expiration, wherever I got in, like this particular spread right here expired at like 24.90. So if I bought in at 24.10 and I let it expire at 24.90, what's the difference there? Well, if I bought at 24.10, it expired at 24.90, that's 80 pips, right? $1 a pip, that's $80, correct? Okay. What if I bought in right here at 24.10 when the market was at 24.10 and I got out when it was at 24.50? How many pips is that? 24.10 to 24.50. 40 pips. So I can exit wherever, right? Now, let's just say, for example, okay, Chris says, all right, if it passes your floor or ceiling, is there any point in keeping it any longer? Not necessarily, Chris. That's a good question, because let's look what happened right here. Let's say I bought it at 24.10. It comes all the way up here to my ceiling. I'm at max profit, right? I can't make any more, really, right, Chris? Now, if I exit it, yeah, I might pay a few dollars bid-ask spread, right, which is just normal, but I'm not going to keep making money. So I might want to close it out. Why? Because look what happens. Boom, boom, boom. It comes all the way back down, right, Chris? And it scares you. Luckily, this one came all the way back up. But yeah, you might want to consider closing it out when you're at max profit. Now, some people say, yeah, but if you close it out early, you'll have to pay some bid-ask spread, a few dollars. You know what? Don't be greedy. Close it out and move on. Go to the next trade. Because look what happens, right? It can go up and down. Or you know what else you might could do, Chris? If it comes up here, or Christopher, if it comes up here and you close out at max profit and you think the market's still going to go, you can get into another spread that's got a higher ceiling, right? Jim says, would somebody buy it if it's at max profit? Well, Jim, most likely no, somebody's not going to buy it, okay? But they might, because maybe they're going the other way. Maybe they're going the opposite way, okay? But the market makers are also quoting bids and asks, right? Like, for example, let's see here. See, you can buy or sell, okay? Now, these are just so far past. I'll show you that in a minute, all right? But someone could be also going the other way, just like with binaries or stocks or anything, right? It's like, oh, when a stock's at a high, am I going to sell it? Is anyone going to take it? Well, maybe they think it's going up more. Maybe they think it's going down. Maybe, you know what I mean? Okay? So you can exit it any time, or you can hold it until expiration. Okay? And if the spread expires, it will close at the settlement price at the time of expiration. The settlement price is based on the underlying market. There's all kind of different spreads. You've got 2-hour spreads, you've got daily spreads up to like 22 hours, you've got 5-hour spreads, all kind of different spreads to choose from with different floors, and ceilings. Okay, now let me kind of show you an example here. Just what we were looking at a second ago, these spreads here. This spread here is from what? 1220 to 1280. This one's from 1220 to 1250, 1235 to 1265, 1250. There's different floors and ceilings. Okay, so you've got all kind of different types of spreads. Look here under the small caps. There was a spread that opened up at 1 p.m., expired at 3 p.m. There's one that opened at 2 p.m. and went to 4 p.m. There's other spreads that went from 8 a.m. until 4:15. And these daily spreads opened up last night at 6 o'clock and go till 4:15. There's all kind of different spreads to choose from. There's all kind of different floors and ceilings. Let's say that I'd gotten in a spread earlier, this 12:15 to 12:35. Let's say I thought the market was going up, okay? And Christopher asked, you know, if it passes your floor and ceiling, why keep it? Right. Well, Chris, let's say that I bought this spread and the market went up. And it went all the way up to 12:35. So I made the most that I can make off of that spread, right? Well, what if I closed it out and then I took this spread that was 12:35 to 12:55 and I kept riding the market on up and I got to max profit, close it out, then I could take this spread 12. There's always other spreads to get into usually unless the market is just shot way up or way down. You know what I mean? Okay. Actually, we're going to talk a little bit about that, Chris. Okay. So that gives you a basic understanding of Nadex spreads. Seems pretty straight up and pretty simple, right? It's about where I get in compared to where I get out, and it's $1 a tick for the difference. Is that simple enough? Everybody see that? It's not like a binary. It's not 0 or 100 at a certain strike. It's not like a binary. It's not all or nothing. It's a simple matter of where I get in compared to where I get out, how many ticks was that, right? And $1 a tick. That makes sense? Any questions on just that very basic concept of spreads? There's a top and a bottom, a floor and a ceiling. You're protected there. And where you get in compared to where you get out is $1 a tick. So, real quick, if I were to buy this spread right here, okay, I'm just going to buy it in my demo account, all right, just to give you a quick example here. All right, so if I were to buy this spread right here, okay, where did I buy it at? Average price right here. I bought it at $12.27. So I can hold this spread until expiration. It expires in 52 minutes or 51 minutes, right? Okay. So I can hold this until expiration. What if I want to exit early? What do I have to do? Well, I bought the spread. So if I want to get out of it earlier, I have to what? Sell it. Okay? If I sell a spread and I want to get out of it early, I buy it back, as it were, right? So if I bought this spread right here, okay, which was this spread. If I want to sell this spread right now, what price can I sell it for? Because remember, the offer is the buy side, the bid is the sell side. So I bought it for this. I can sell it right now for what? For this, right? That is how it's determined what I can get out of it for, okay? So as the market moves up, these two prices will move up. As the markets move down, these will move down. Now notice there's a difference in here, right? 1227.1, 1226.6. There's about 6 ticks of difference in there. What is that called? That's called bid-ask spread or bid-offer spread, right? That's how a market maker makes their money, right? They'll sell it to you for this. They'll buy it from you for this, just like a car dealer or anything else, right? Buy low, sell high. That little bit of a spread there is how they make their money, right? They're not betting against you. They're just saying, I'll buy for this, I'll sell for this. So take a look here. right now, and again, I was just entering a spread here to show you, where's my profit and loss? I'm down $6 right now, right? Why am I down $6? Because I bought at 12.27. What can I sell it for right now? 1226.6. Notice right here, see right here where it says current market? See this number? Matches this number. Does that make sense? So I bought for this, 1227. I can sell it for this, 1226.6. What's that difference? 4 pips. Dollar a pip is $4. Well, now it's 5. So does that make sense? If I buy it, what can I sell it for? Well, whatever's listed right there. So everybody got that? Any questions on that particular part right there? I'm going to kind of piece this all kind of come together here in a minute. Some of this is very basic and elementary for some of you guys that have been around. But for some of you that might not fully understand spreads, we kind of need to set this foundation. So everybody understand that? And it would be the exact opposite. If I sold it, what could I buy it back for? That price, right? Okay, so there we have that. Now, let me ask you a question here. I'm going to flip over to just a random chart here. Let's say that, let me do this, current price. Let's say that the market is right here, 48.1750. Let's say there was a spread that's going to open up right now at 48.1750 and go up. Do you think that the market makers, having that little bit of a spread in there, whatever, do you think, okay, I want to buy this? Do you think they're going to let you buy it right at literally at the bottom? Are they going to let you buy it at 48.1725? Because okay, if the bottom was 48.1725 and you wanted to get in that spread, you don't have any risk at all. There's no risk. There's no, right? Because you're at the bottom. Does that make sense? You're at the bottom of the spread, right? Because your risk is limited to the bottom. They would let you buy it, say, somewhere up in here, right? Like 48.19 or something. A few ticks difference, right? Because they've got a little bit of a buffer in there. It's what's called premium. In the option world, that's called premium, right? Does that make sense? Everybody understand that? If I have no risk past this point, I'm not going to be able to get into this spread for 0, right? I'd probably have to buy into it wherever they have it priced, which maybe would be somewhere in here, just depending on how much the market's moving or whatever, right? Does that make sense? Everybody can understand why. So it's called, that's what's called premium. When you're right close to the floor of a spread, you don't have a lot of risk there, do you? Your risk is very low. So you're going to pay a little bit of a premium for that. When you think of the word premium, what's the first thing that comes into mind? What is a bill that you probably pay every single month and you pay your premium? Your insurance premium, right? On your house, on your car. And why do you pay a premium every month? For protection. Same thing here. If this spread, for example, was 100 pips wide, okay? What would happen if you bought the spread way up here? If you bought in way up here, you only have a little bit of room to profit, right? But you have a lot of room for loss all the way down to the floor, right? Does that make sense? So if you bought way up here, you've got a lot of room for loss. Yes? But when you buy down here, You only have a little bit of room for loss. So yeah, you're paying a little bit of a premium for that protection. Does that make sense? So the market, let's say the market's only right here where it is, but you buy in up here. You understand why you're buying in higher than the market? Because you got a little protection there. Does that make sense? Did I lose anybody just right there in that basic kind of elementary explanation of premium? Raise of hands if I did, because it's very, very important. Okay, so everybody understands that, right? So if my chart, indicator, strategy system, whatever, is telling me that the market's going up, and let's say I'm right. So let's say I bought this spread right here. I bought in right there. And the market starts to come up. 1 pip, 2 pip, 3 pip, 4 pip, 5 pip, 6 pip, 7 pip, 8 pip, 9 pip, 10 pips. Well, what's going on with this spread? The market just moved 10 pips. And my spread didn't go up $10. That guy John on that webinar taught me that spreads are $1 a pip. Okay, that's not exactly what I taught you. What I taught you was spreads are $1 a pip from what? The price I get in to the price I get out. Right? So you bought, the price you're able to get this spread for was way up here at 48.20. See the pricing over here? 48.20. Where's the market at right now? It's at 48.14. So do you think your spread's going to quite move $1 a pip if it's not even up to the point where you bought in yet? Does that make sense? Does everybody see that? Did any of you newbies or anybody that's just starting to play with spreads go, aha, that makes sense? Because I'm sitting here saying, forget these spreads, they don't work. Because I got into a spread because I thought the market was going up, and I was right. The market went up 30 points. But I only made like 10 bucks on my spread. How many have had that happen? Show of hands. Yeah. Right? Some of you have had that happen going, yeah, it went up 30 pips. I was wondering why I didn't make 30 bucks. Well, the reason is you probably did not pay attention to the price of where you got into the spread. Okay? When you get into a spread that's close to a floor, like when you're buying, or you get into a spread that's where the market's close to the ceiling when you're selling, you're normally going to have a little premium in there. If you get into a spread kind of in the middle, then you're normally getting in right close to where the market is, and it mimics at $1 per tick a lot more. Now, I'm not telling you your spread's not going to move in value at all from here to where you bought in. It will, but it's not going to really be moving like dollar for dollar until you kind of get to that point, as it were. Does that make sense? Does everybody see that? Okay, so here's the issue. You need to understand that. So you need to understand where you're getting into the spread. Okay? And you need to have a good understanding of what are you expecting the market to do. Are you expecting just a little move? Are you expecting a huge move? Well, hey, if I'm expecting the market to be hundreds of points move today, hey, maybe I'll take this low risk spread, right? And maybe only have to put up a few bucks, 6, 10 bucks. And maybe I'll get a bunch of these spreads because I'm expecting the market to go crazy, right? But what if I'm just expecting a 20, 30 tick move from the market? Well, maybe I want to put up a little more money to get into the middle of a spread that's going to mimic a dollar a tick, right? But here's the biggest thing. So you have to look at what price are you getting into the spread at. So let's go back to the Nadex platform. It's right here. You don't have to wonder. It's right here. Okay? And you can see, remember, there's different floors and ceilings. All right, so you can easily figure out, are you getting in at the bottom or the top? So another example. Yep, exactly, Jim. News could affect that as well. All right, if you're expecting a big move for the day, the market's been volatile, maybe there's some huge news coming out that you think will affect it, maybe you do want to look at one of those spreads that are a little closer to the floor or ceiling perhaps. But Jim, you have to pay attention to how far away are you getting into the spread compared to how much of an expected move is coming from that news cycle. Meaning, historically, that news event moves the market 40 pips. But there's a lot of premium built into these low-risk spreads right now, and I got to pay 30 pips of premium. So I've really only got about a 10-pip kind of room there. You know what I mean? You have to look at those two things combined. So let's take a peek here real quick. And actually, I want to look at one other example. Give me just a second. I want to see how we're looking on these spreads right here. The market's moved so far on some of these, 48.60. Okay, well maybe I want to do one of these spreads. Let's see here. I can buy this spread. Oh look, I only got to put up $6. I like that. Okay, cool. Let's see here. This spread, you know, I only got to put up, let's see here, how much? 75.6. All right, well, let's go back to our other example here. Remember where we were in the beginning, the example I marked. I can tell you where most of the problem comes here, guys. It's just the same exact problem that you have if you're a binary trader and if you don't understand binaries. You say, all right, I'm going to trade some binaries. Man, there's a lot of different binaries to choose from. Oh, okay. If I get this one right here, let's say I want to buy this binary. If I want to buy it, oh man, max loss 65 bucks. Oof, I don't like that. I don't like that. I don't like having to put up 65 bucks. So, oh look, I only got to put up $6.50 on this one. That's my risk. I like that. Any of you that know binaries know, where's the market at right now? 1224. This binary you're looking to buy is way up here at what? 1271. That's a huge, crazy far amount away, right? Does everybody get that? But that's the biggest mistake people make. They didn't look at that. They don't look at where is the market, 1224, and what am I buying, 1271. That's a huge difference. No wonder you're only paying that much for it, right? No wonder it's such a low risk. And so what do? You say, well, my charts, my indicators, my strategy, my system says market's going up. So I know that market going up means I buy a binary. So I bought this binary, and I was right. The market went up from 1223 all the way to like 1250. It was a huge move in the market, but my binary lost. These binaries don't work. Did the binary not work, or did you choose one way, way out there? Yeah, the market went up. Yes, it went up a lot. Yes, you buy a binary, the market's going up, but you bought the wrong one. All you looked at was price and amount you had to put up, not what am I buying, right? Same thing here on this chart in the very beginning. Remember, when we started this webinar, I said, hold on, let's do this. Where was the market at? Still right about where it is right now, 1221, right? Remember, we looked at a couple different spreads. Oh, I'm clicking through the spreads. I got to put up $37 for this spread that would get me in right here. But, ooh, I only got to put up $6 on this spread that got me in way up here. But if all you looked at was this amount of money to put up, if all you looked at was that risk amount, let's go back to it. Should still be about the same. No, we're on binary spreads. Russell 415. Yeah. Look, this spread right here. Okay, let me click that spread. If I want to buy one, oh look, $6, guys. Let's do that. I like that. I can put up $6 and I might make 194. I love those odds. Let's do it. Where are you buying this spread at? 1255. Where's the market? 1224. Back to the chart. 1255. See the price here? Does everybody see that? So, okay, that guy John from Apex, he did that webinar. I know spreads are $1 a tick. I've got this great system, great strategy, great indicators. Market's going to go up. Look, so I'm buying a spread. Ooh, $6. Hey, man, you know what? For only $6, I can do like 10 of these things and only risk $60. Think of all the money I'll make. I'm going to do 10 of them. Market's going up. My strategy system's right. Cool. Strategy system's right. Market's starting to come up. Market's coming up. Market's going up. Market's going up. I've got the greatest system in the world. I called this move right. Market's going up. Man, this is great. It's still going up. Look at this. It's moved from 1221 up to 1232. Wow. 11 points times 10 ticks each. Man, 100 pips already. I should have made $100 on a spread. And I got 10 of them. So I should be up $1,000. It's not even up here to where you got in the spread at. So do you think you're making $1 a tick times 10 spreads? Does everybody get this now? And the market keeps going up and keeps going up and keeps going up, and then your spread expires. And the market's made this huge move, and you only see a little bit of, I mean, your spread's moving in value. It's going up. It's not going up $1 a tick, but it's definitely going up. You made money, but you're wondering what the heck happened. The market moved up 200 ticks, and I only made like $50. These spreads don't work. No, Jim, you'll actually get money. Okay, you don't have to wait till it gets there to start getting any. It'll actually move, but it'll move like, instead of $1 a tick, maybe, you know, 50 cents a tick or 30 cents a tick or something. You know what I mean? Because as the market's moving up, it's increasing in what it's worth value-wise, but it's not going to be $1 a tick. Okay, it's going to be like a fraction of that until it kind of catches up, as it were. All right, it's just kind of the way the options work. Like the top 30% and the bottom 30% are going to move at like maybe 0.4 to 0.7 compared to that middle 30% that'll move more like 1 to 1. But does that make any sense? Why some of you feel like spreads don't work? Because I'm calling it right, my direction's right, my strategy's right, the market moves, but I don't make much money in the spreads. Why? Because I didn't understand it. And because all I looked at when I hopped over here to Nadex, all I looked at was max loss, $6. Compared to I could have got this one. That might have been $14. Or this one, that might have been $91. Oh, no way, forget that. $91, no way. Really? Where is it at though? Where are you getting in? 1224. Where's the market at? Where's 1224? 1224 is right here. It's very close. Just a little bit of move in the market up, and you're going to be going tick for tick, dollar for dollar. Does that make sense? Does everybody see what I'm showing you here? Okay? That is the biggest misconceptions with spreads, is that you're just looking at the dollar amount you got to put up, not where am I getting in compared to where is the market at right now. Because the closer I get into right where the market's at now, the more I'm going to make tick for tick of the move. Does that make sense? Okay, so that's the first thing I want you to look at and realize when you're trading spreads is where are you getting in? Okay, and the other thing you've got to be you've got to really understand here. You're like, okay, John, great little presentation, I get it. I get that only $6 up here and why I'm not making the move. I get that. But John, what I don't like is, come on, $91 max loss? John, that scares me. I get that that's the better spread possibly to make money quicker, but losing $91 scares me. It scares all of us, right? We don't like to see that big amount right there, do we? None of us do. But here's what you got to stop doing. Stop thinking like a binary trader. When you trade spreads, these aren't binaries. So when you see this max loss $91, you're freaking out. Let's go back to binaries for a second. Okay? Let's just look at these. Okay. All right. If I want to buy this binary right here, I want to buy it. One of them. Boom. Max loss $89. You feel your heart beating right now, don't you? Like you hear it, you feel it. You're like, oof, oof. Risking $89. Why? Because you know, first of all, you're risking 89 to only make possibly 10. You don't like that. But what you don't like is seeing this mass loss of 89.25 and knowing that in 12 minutes, 11 minutes and 58 seconds, that $89 can be gone, right? And here's the other thing. What are you buying here? You're buying a binary contract statement. What does the statement say? Small cap 2000 be greater than 1221.2 at 4 o'clock, right? That's all a binary is, right? So what really scares you about this right here is, what if the small cap at 4 o'clock expires at 1221.1? What happens? Your binary says 1221.2, and if it expires at 1221.1, Christopher says, toast. You lost $89 based on what? One tick, right? So that's what scares you when you see this, because you're a binary trader. That's what scares you, right? Okay, stop thinking that way. Forget that. Binaries are all or nothing, okay? Forget that. Don't let this number scare you when you look at spreads, because, let's pull it back up. Okay, I want to trade the closest spread. Okay, what is this one? Oh my goodness, max loss $100. No way. All that is the amount of money that you have to put up to get in the trade. Why do you have to put up $100? Where's the floor? 12.15. Where were we just looking at buying in? Right about 12.25, which would be about right here. That's what we can buy in at. It was just 12.25. 12.15 to 12.25 is what? 10 points, 10 ticks in each point, so 100 ticks. That's why you had to put it up, right? If it's a spread and it's a 100 pip spread and you're going to get in right in the middle at 50, what's the most you can lose? 50. So how much do you have to put up out of your account to just enter the trade? 50, right? If it's a 100 pip spread and you can buy in at 30, what's the most you can lose? 30. How much money you got to put up out of your account to get in it? 30. Everybody get that? If it's a 100 pip spread and you buy in at 80, what's the most you can lose? 80. How much do you put up out of your account? 80. People wonder, how do they determine how much money I got to put up for a spread? Right there. Does that make sense? So, I'm freaking out over here because if I want to get in a spread at, what was it, 12.25? Remember that one we just looked at? 12.25. Okay. How much did I have to put up? $100. Oh, forget that. No way. I'm scared. Right? It's not a binary. What just happened when we were looking at that binary and it expired one tick below your strike? How much did we lose? Anybody remember? $89. If I put up $100 to get into this spread right here, because I think the market's going up, I'm going to buy. If I put up $100 out of my account to get in this spread and it expires one tick below, how much did I lose? $1. Do you see the difference? Don't be so scared of that max loss number on the spread side, because that's the amount that you have to put up to get in the trade. You're thinking like a binary, that one tick and you'll lose it all. One tick, yeah, you might have to put up $100 to get in this spread, and it expires one tick below, you lost $1. What would have to happen? Jim says, now I understand. You see it, Jim? Because it's a difference of where I got in compared to where I get out. And it's $1 a pip for the difference. So for me to think like a binary trader, if I had to put up $100 to get into this trade, what has to happen for me to lose that whole $100? I got in at 12.25. Where does the market have to go for me to literally lose that whole $100? Yeah, it has to drop 100 pips. So if I'm sitting here saying my charts, my indicators, my strategy is telling me the market's going up, so I'm going to buy this spread. But I'm wrong and the market's starting to head down. Down a few pips, down a few pips, down a few pips. Now it's down 20 pips. Now it's down 25 pips. Now it's down 30 pips. Am I just going to sit there and watch $100 just go? No, I'm probably going to close out that trade after it's down 20, 25 pips or something, right? And say, hey, I was wrong. It wasn't going up, it's going down. So I had to put up $100 to get in the trade, thinking it was going up. But it dropped down against me 30 pips. All my indicators turned around saying short, so I close it out. How much money did I lose? 30 pips, $1 a pip, 30 bucks. So yeah, I had to put up 100 bucks out of my account to get in the trade. But the market moved against me 30 pips. And I got out and only lost 30 bucks. As to where if I'd put up $90 on that binary and it went against me 1 pip, I lost it all. Does that make sense? Don't be so afraid of that number that you have to put up, because if you're managing your trade, you're managing your trade and you're getting out. Does everybody follow me there? Any light bulbs kind of go off there like, okay, got it. Now I realize that I shouldn't be so worried about that number and manage my trade. Now I realize, don't just look at the cheapy dollar amount, because it's going to put you getting in way up here, and no wonder I haven't been making any money. Okay, sell the spread is the same way. It's just opposite. It's the same exact thing, just opposite. Okay. Christopher, would adjusting the buy and price on the ticket for less premium be a more advanced course? Yeah, a little bit more advanced. Let's say that you didn't want to get into a spread until it got to a certain level, so you just put a higher price in that ticket to wait till it got there. You know, you could do that. Yeah, that's a little bit more advanced. And we're kind of running out of options to kind of show you live because it's already 3:56 p.m. here, so a lot of the spreads are about to expire. But I just, those are the main points I wanted to get across to you, because those are the two biggest misconceptions when it comes to Nadex spreads. Is the misconception of that higher dollar amount risk scaring people, just like a binary, because it's not one tick all or nothing, or technically 1/10 of a tick all or nothing. It's $1 a tick. You literally have to watch the market move against you 99 pips. You know what I mean? Okay. James, it all depends on the market, but yes, like that particular one we were just looking at, like the Russell. Okay. Yes, see, it moves in like 22, 8.1, 0.2, 0.3, 0.4. So there's 10 ticks between 28 and 29. So $1 a tick, yes. So 28 to 29 would be 1 point, but it'd be 10 ticks, so it'd be $10. Okay, does that make sense? Some things on your chart will tick in quarters, like on a NASDAQ chart, for example. It ticks in quarters, like 20.00, 20.25, 20.5. So on your chart, it will be in quarters, but on Nadex, it's still in dimes. So 1 point from 20 to 21 on your chart may be 4 ticks, but it's still 10 ticks on Nadex. Little confusing there, but yeah. Okay, and you always know on Nadex you can look at the last digit quoted. Okay, whatever's the last one there is quoted, that's how it moves. Okay, so again, guys, those are the two main things I wanted to make sure that you understood. That makes all the difference in your spread trading. And like I said, I mean, I'm going to zoom my chart in here. Look at some of these moves the markets have been making the last few weeks. I mean, look at just today. I mean, look at today. The Russell here, for example, what was that? 1246.4 all the way down to 1218. Almost 30 points, meaning 300 pips. Guys, that's a huge move. That was 300 pips today. Yeah, a lot of money on the table there for an experienced trader. So think about this. Think about this. Do you really want to sit there and give me grief about the fact that you might have had to put up $100 to enter a close proximity spread to start making money, hopefully dollar for dollar, tick for tick, pretty close with the market. So you had to tie up $100 out of your account today just to get a tick for tick close to the mimicking the market move on a 300-point move for the day, 300 tick move for the day. One spread would have made you how much money if you'd caught this whole move? No, Chris, 300. Because that was 30 points. Remember, there's 10 ticks in each point. That would have been 300. Yes, one spread. Yeah, one spread because it's $1 a pip. Oh, right. Okay. Well, Chris, some of these spreads are huge though. Okay. And maybe you got into, maybe one expired and you got into another one. All right. And you know what I'm saying? But like right here, 55 to 75, that's 20 points. That's 200 pips. Remember again, like one expires, you went on to the next one. Okay. I'm just saying putting up money for one spread, because you could have gone in here and done 10 and made $3,000 on that move, potentially. So is it really worth worrying about that when you've got a big move? Okay. And my point is, see these huge moves of the market, and let's say you have a great system and you call it, just like right here. Let's say the market's way down here and we called a 300 in your system or strategy, called a few hundred points move up. If you don't know what you're doing and you're choosing these wrong spreads, you're missing it. You see that? You're totally missing it. And so that's why with these huge moves going on, I know we covered this before, and some of you may be like, okay, John, I know this. Why are you covering it again? Because it's huge. Because if you're not doing it right every day and you're trading here, you're missing these moves and you're leaving a lot of money on the table. Okay? Jim, so if your trade crosses the floor, it doesn't matter, still dollar loss per pip. Jim, not sure what you mean there. No, if you have a floor and ceiling, that caps your risk and profit. Okay? So remember in our examples before here, and then we've got to call it a day here. So if I'm buying, saying the market's going up, if I buy right here saying it's going up, but it goes down, as soon as it hits my floor, I'm done losing money. It can go against me hundreds of pips. I only lost from where I bought in to my floor. Okay? But if I'm right and the market goes up, I make money all the way to the ceiling. But then it stops. But what if the market keeps going up? Well, I can just hop into another spread that has a higher ceiling. Remember? Let's say I bought this spread at 12.15. The market went all the way up to 12.35. Boom, I take my max profit. Then I hop into this spread that goes from 12.35 to 12.55. Boom, I max out. I want to go. There's more spreads to keep going. So just because I hit my max profit doesn't mean I have to be done for the day. I'm done with that spread and close it out. But there's more spreads available going up or down. Make sense? Okay. Well, guys, we've gone a little bit over here. I really hope that helps clarify a couple of very common misconceptions with Nadex spreads, and I hope that helps you with your trading to be able to take advantage of these great moving markets, but take even more so advantage of the capped risk products with Nadex. So thank you for joining us today. Hope to see you next Monday and each and every Monday for these application and strategy webinar series. Yes, this webinar is being recorded. Should be up in the Nadex webinar archives here in the next day or two. Feel free to hop on over to apexinvesting.com. Check us out. Got literally hundreds of hours of free education over there, some step-by-step training courses on binaries and spreads and all kind of strategies and systems. Go ahead and check us out over there. Let us know if you have any questions, and make sure to hop on over to nadex.com and open up that free demo account. Start testing and playing with these spreads. with any strategy or system that you are trying to master. And we will see you next Monday. Hope you have a great evening and a great trading week. Thank you again for joining us. All right, guys. Thank you. I appreciate it. Gary, you too. Chris, James, thanks a lot. Thank you for the great questions and feedback as well. All right, guys. Thanks a lot.